So welcome to the Genus quarterly video. We hope to bring you up to date on what's happened recently in the markets. I think one of the interesting things that's happened when people aren't really talking about is the currency movements. So Wayne, I thought maybe you could spend a moment telling us about that.
Well, this quarter was a big quarter. We're seeing the beginning of the end of easy money. And we've had easy money now for 8 years. The US was the first to tighten interest rates, and the rest of the world is catching up. And we got signals from the European Central Bank, from Canada and Australia. And a result of that, their bond markets reacted, spreads have narrowed versus US, and their currencies got lifted as well. So we've seen stronger currencies against the US across the world. And so the rest of the world is simply catching up to the US. The US has moved into this latter part of the cycle where the economy is heated up somewhat, and the rest of the world is catching up.
It's just that Canadians focus on the US-Canadian exchange rate so much, so I don't think Canadians realize that our currency has done poorly against Europe.
Yeah, it's going to cost you about 148 if you go to Europe.
Right.
And I'd say every time I go to Europe, it's 140.
Yeah.
It's 148 right now. It's a little bit
Exactly.
little expensive to go.
The other thing that I think clients are they're very aware of is interest rates, and here they're dropping again, and people want return, they want safe return. We always say that's very difficult. Is there any change there?
Well, Canadian rates have backed up quite a bit. In fact, the 10-year's backed up from 135 to 2%. And that's the second biggest backup the biggest backup in rates since 1994. So it's good for Canada. US rates really haven't moved that much because spreads have come in so much against the US.
Is it reflected in GIC rates?
Not so much there, I would say.
That's where our clients notice it.
Yeah. But in the bond market, this over the past quarter or so has been negative, and it's not helping with client returns either. So
Wayne, talking about the markets and just bond market hasn't done well. We talked earlier about Europe doing well. I looked just before coming up here at our European or EFI exposure, June 16 versus June 17. It was 10% a year ago, it's now 18%. So obviously we did a good job there. On the bond side, we haven't liked bonds for 8 or 9 years. So that's not new, but what we have done is we've come back to a neutral weight on stocks. Mm-hmm. So our signals are slightly negative, and tell us a little bit about that.
Well, we have two signals that we look at, stocks versus cash, and that's gone neutral to negative, and stocks versus bonds, and that still is positive. We still like stocks much more than bonds, and that's keeping stocks in our portfolio and keeping us out of bonds. So we've raised a bit of cash, about 10% cash, which has come from stocks. And so we're neutral-ish in stocks right now, and looking for reasons to go maybe further below our benchmarks.
Or the market might take us further below, which kind of leads me into the next question, which is a lot of our clients, I hear these things from clients, so it's fun to ask you about them. September, October is often a horrible period in the markets, and particularly after maybe a 6-year run in the stock market. So clients are nervous. They're looking for a catalyst for why the market's going to sell off. This morning, Korea might have been one. Today's the day that Fire and Fury made the tweeting yesterday afternoon. And yet the market performed well today. So what do you think? Should we be worried about this September, October correction?
Well, I'm always worried about September, October. Its seasonality is definitely a factor. If you look at the research, if the market is up in the first half, the seasonal weakness in the second half usually isn't as bad. It's quite pronounced, actually. If the market's down in the first half, it is a weaker second half as well. So
success begets success.
That's what happens, and we hope the same thing happens this year. From our perspective, seasonality is there. We're seeing a bit of tightening, but still there's ample liquidity out there.
Right.
There's enough liquidity out there, and that's why the markets are responding okay to everything else. So we've had some snugging up by the U.S. Fed. They've tightened a little bit, but still there's ample liquidity out there. Valuations are a bit on the high side in the U.S., not so much on Europe. There's still a valuation gap in Europe between Europe and the U.S., and that's why we're overweight there. And there's more good things happening in Europe as well. We think the French election was a positive for deregulation, and the center is holding in Europe as well, which is another good thing.
Right.
And they still have the monetary stimulus behind them as well. So 3 good things driving Europe the way we see it, and good for the globe as well.
Does your team follow just how much liquidity is in the system? Because clients have a lot of cash. They're afraid to invest it. Investors have a lot of cash. So they're going a lot to alternative spaces. Some get tempted to go into high-risk private debt. Private equity is robust with cash. Does Genus look at that?
Yeah, well, every quarter we always look at money supply. What is the growth there? And it's not so much money supply growth, it's money supply growth less economic growth. So we've had decent money supply growth, and the economic growth hasn't been that strong, so there's enough liquidity floating around above and beyond the economy growth, the economic growth, to go into markets. And also, we also look at corporate spreads. Corporate spreads are still narrow. They haven't been blown out. There's no credit crunch happening there, so there's no issues from the liquidity perspective, and that's why this market's behaving the way it is.
So it's been a good start to the year, and we don't see any big problems in front of us, but our knees are bent. And if you
We're on our toes.
if you have any questions, please call your portfolio managers. Thank you very much.